Hello, Accounting 101 students. In this question, we're going to go over whether a company should utilize debt financing or equity financing when they're trying to finance the construction of a new plant. And this is question 2 in the Chapter 11 end of chapter practice exercises. So you can see that in this problem, Larkspur Inc. is considering two alternatives to finance the construction of its new $1.7 million plant. So that's the amount that they need to finance. And in the first option, they can issue 170,000 shares of common stock at the market price of $10 per share. So if we take 170,000 shares times $10, that will equal 1.7 million. In the second option, the company can issue $1.7 million 6% bonds at the face value. So we're going to go over this table comparing and contrasting the two options. And one of the considerations is that when a company has common stock, they do not need to pay interest expense. However, if you're issuing bonds, then you need to pay interest expense. So that's something that we learned in our previous chapter. So we're going to first start off with the scenario with issuing stock. So if a company issues stock, then that means that we do not need to include a dollar amount for interest expense. So our interest expense is just going to be 0. And then our income before income taxes will just be the same number that we have before for our income before interest and taxes. So it's going to be 1.620, and I'm going to add in our 3 zeros at the end. Then we're going to compute our income tax expense by taking 1,620,000. So I'll make a little side note right here for this calculation. Income tax expense, we're going to be taking 1,620,000, that's our income before taxes, times the 40% tax rate. And this is going to equal 648,000 when you include this in your calculator. So this is going to be our income tax expense that we need to subtract in order to arrive at the net income. So we're going to subtract out our income tax expense. In order to arrive at our net income, which will be 972,000. So that will be our net income when we are going to issue stock. Our other option is to issue bonds. So with bonds, we have to pay our income tax expense, but we also have this additional consideration where we also need to pay interest expense. So our interest expense is going to be calculated by taking the amount of the borrowing. So that's going to be 1.7 million times the 6% interest rate. And we're going to be computing this for the entire year, so times 12 over 12, or just for the entire year. And that's going to equal $102,000. So now we're going to take our income before interest and taxes. We're going to subtract out $102,000, and this will equal our income before taxes, and this will be 1.518000. And now we need to compute our income tax expense using the income before income taxes. So our income tax expense will equal our income before taxes, 1,518,000, times our tax rate of 40% that is provided in this problem. And when you put this into your calculator, you'll end up with 607,200. So we need to subtract out our income tax expense in order to arrive at our net income. So this will be 910,800. So we can see between the two options, our net income is going to be higher when we are going to issue stock. Okay, so we're going to have a higher net income. But the next thing that we want to consider is earnings per share. So for earnings per share, this is the same formula that we learned earlier in our semester. And our earnings per share is going to be calculated by taking the net income minus preferred dividends if you have any. And once you subtract out any preferred dividends from the net income, you need to divide this by your weighted average number of shares outstanding. So in this problem, when we're given our data, it didn't tell us the number of shares outstanding, but we can see the number of shares outstanding in this problem because they tell us that when we issue bonds. So our outstanding shares, if we issue stock, would be 720,000 plus the 170,000 of additional shares. So we're going to end up with 890,000 outstanding shares. Then we can start with our earnings per share calculation. For our stock, go ahead and include this calculation up here. Our earnings per share is going to equal our net income of 972,000 minus 0, because we don't have any preferred dividends in this problem, divided by 890,000. And when you do your math here, you're going to end up with 1.09. So earnings per share will be 1.09. Next, we need to compute our earnings per share if we were to issue bonds. So we're going to take our net income, which is lower in this case. There's no preferred dividends, but we also notice that we have less outstanding shares. So when we do the math here, we end up with 1.27. So we can see that our earnings per share is actually going to be higher if we were to issue bonds. So if a company really focused on earnings per share, they would utilize issuing bonds if that was the most important factor for that company. Okay, so bonds are preferable in this scenario if you're looking at just earnings per share. So you can see that this is one of those important business decisions that a company would have to make. And thank you for taking the time to watch this video.